If you're a business owner or incorporated professional in Canada, the chances are you've been told at some point to consider setting up a holding company. Here's what I found after years of working with successful clients. Most people hear the term, few understand what it actually does, and even fewer set one up when it would make the biggest difference. It's not your fault. The concept of a holding company often gets buried in accounting language or tax jargon. You're running your own business and you're focused on today, but meanwhile, you're accumulating retained earnings inside your corporation, and those funds may be exposed to more tax and more risk than necessary. That's where the holding company comes in, because when used properly, a holding company isn't just another legal structure. It's a strategic tool that can help you defer tax, protect long-term wealth, streamline future succession, and separate operating risk from personal or family capital. In this video, I'm going to walk you through how a holding company works, when it makes sense, and what thoughtful Canadian business owners are doing to make the most of it. Hi, if you're new here, my name is Scott McCartney, and I'm a portfolio manager with Novus Pro of Raymond James. What do? I help Canadian business owners, families, and professionals navigate complex financial decisions by turning technical knowledge into practical, actionable strategies. So whether it's retirement income, corporate planning, or intergenerational wealth, the goal is always the same: to help you keep more of what you've built, protect it from unnecessary risk, and pass it on effectively when the time is right. Today, we're talking about the holding company, what it is, why it matters, and how thoughtful business owners are using it to support smarter tax planning, investment growth, and long-term control over their wealth. Here's part one. What is a holding company and how does it work? So a holding company, or a holdco, is a corporation that exists primarily to own shares in another company, usually your operating company. So you own 100% of the holding company. The holding company owns 100% of the operating company. Your operating company is where you run the business. It earns income, it deals with customers and employees, and it carries the day-to-day risk. The holding company doesn't operate a business. It holds investments, it receives dividends, and it protects capital from operating risk. So here's the key advantage. Your operating company can pay a dividend to your holding company, and that intercorporate dividend is usually tax-free. That means you move profits out of your business without triggering personal tax. Once the money is in the holdco, here's what you can do with it. You can invest in real estate. You can purchase stocks, ETFs, or mutual funds. You can fund corporate-owned life insurance, or you can save it for future retirement or succession planning. And because it's now outside of your operating company, that capital is also shielded from lawsuits or business liabilities. In short, a holding company gives you flexibility. It creates separation, and it opens the door to strategic planning on your terms. Here's part two, the tax deferral advantage. Why timing matters. One of the biggest advantages of a holding company is tax deferral. When your business earns more than you need personally, you don't have to pull that income into your personal tax return right away. Instead, you can move it to your holding company tax-free and defer personal tax until a later time. So let's say your business earns $500,000 this year. You only need $150,000 to live on. You move the rest, that's $350,000, into your holding company. You haven't paid personal tax on that income yet, and you won't until you actually draw it out as dividends or salary. That's the power of deferral. In the meantime, that money can be invested and continue to grow inside the holdco. This is especially helpful if you plan to retire soon and expect a lower personal income. You want to avoid OAS clawbacks. You prefer to time large withdrawals for the lower income years, or you simply want to control your own income flow. Yes, eventually you will pay tax, but when you defer income until the timing makes sense, you reduce your overall tax burden. You keep more money compounding. You stay in control, and you avoid triggering unnecessary clawbacks or bracket jumps. Part three, asset protection and risk separation. Let's talk about one of the most underrated benefits of a holding company, protection. So if you're a business owner or an incorporated professional, your operating company, or OpCo, is where the risk lives. You're dealing with customers, you're entering contracts, you're managing staff, and whether you realize it or not, your business is exposed to liability every day. It could be a lawsuit, it could be a tax audit, it could be an unexpected event that affects your ability to operate. Now imagine you built up hundreds of thousands, maybe even millions in retained earnings inside that same company. What happens if that company is sued? All of that retained capital could be vulnerable. That's where a holding company makes a real difference. How separation works. When you move retained earnings from your operating company into a holding company, what you're doing is you're creating a legal separation. These are now two different corporate entities. What does that mean? That means that assets in your holding company are not exposed to operating company liabilities. Creditors, legal claims, or disputes in your operating company cannot automatically reach the holding company's capital, and you create a firewall between your business risk and your long-term wealth. This is especially important for anyone in construction or contracting, for example, medical or dental practices, consulting, tech or IP-driven businesses, or any industry where liability, client disputes, or regulatory risk is a factor. So here's a real-world example. Let's say you're a general contractor. Your company takes on projects, hires subcontractors, and carries risk with every job. Over time, your business earns strong profits. You build up $600,000, for example, in retained earnings. If that capital remains in your operating company, it's fully exposed. One project goes sideways. There could be a legal dispute, an injury claim, a construction delay, and suddenly that money could be at risk. But if you've been regularly moving those earnings into a holding company, here's what happens. Your investment capital is protected. Your retirement savings are untouched, and your legal exposure is limited to the operating company, not your long-term wealth. That's the power of structure. Some other forms of protection a holdco provides. It's not just legal disputes. A holding company can also help shield wealth from CRA audits or reassessments at the opco level, loss of the small business deduction due to passive income rule, operational bankruptcy or wind down scenarios, business partner disputes or shareholder transitions. You've worked far too hard to build your wealth. It shouldn't be exposed to risks that have nothing to do with your long-term plan. That's why many advisors recommend transferring retained earnings regularly to the holding company once a base level of working capital is maintained in the operating business. An important note on director's liability. Even with a holding company, certain liabilities like, for example, unpaid source deductions or GST can still follow you personally. So a holding company isn't a magic shield. But what it does give you is a clean, separate place to grow and protect capital that isn't part of your day-to-day operations. That separation is valuable, not just for your current protection, but also for the eventual sale, succession, or transition of your business. Part 4, succession, sale, and estate planning advantages. We talked about how a holding company helps with tax deferral and asset protection. But one of the biggest advantages, especially later in your career, is how it supports long-term planning. Whether you're thinking about selling your business, transitioning it to family, or just making sure your estate is in order, a holding company gives you more flexibility, it gives you more control, and fewer tax surprises when the time comes. Let's look at how it supports selling your business, planning for intergenerational wealth, and building a more tax-efficient estate. Number 1, selling your business. If you're thinking about selling your business, could be now, could be in the future, a holding company can play a big role in how you receive and manage the proceeds. Here's how it works. You own shares in your operating company. Those shares may qualify for the lifetime capital gains exemption, currently just over $1 million per person. So when you sell those shares, you can use that exemption to shelter part or all of your capital gain from tax. Now here's the key part. If you receive the sale proceeds into your holding company, you can defer personal tax. You can reinvest those proceeds inside the corporation. You can use the capital dividend account to pay yourself tax-free amounts over time, or leave the funds invested until you need them for retirement or estate planning. This gives you far more control over your tax bill than if you receive everything personally in a single year. And if you have a spouse or children involved, there may be ways to multiply the exemption through family trusts, something your holdco can help coordinate. Number 2, intergenerational wealth planning. A holding company also gives you a cleaner structure for passing wealth to your family. Let's say, for example, your adult child is going to join the business. You may want to slowly transfer ownership without giving up control or triggering any tax. With a holding company in place, you can freeze the value of your operating company shares, transfer future growth to a family trust, and retain voting shares or income through the holdco. This allows your child or children to participate in the future success of the business while you continue to receive income, manage risk, and transition out on your own terms. This approach is especially useful if you have children inside and outside the business, you want to equalize your estate, or you're using trusts to manage distributions over time. The holdco becomes the central tool that holds income-producing investments, funds lifestyle goals, and facilitates gradual transition. Number 3, estate planning and tax efficiency. Now let's fast forward a bit. When you pass away, the shares in the holding company may trigger a capital gain, just like your personal investments would. But here's the advantage. If your holding company owns a permanent life insurance policy, the death benefit may be paid into the company tax-free. That money then flows through the capital dividend account, which is called a CDA, and can be distributed to your estate or your Canadian resident heirs without any additional tax. This creates the following: liquidity to pay estate taxes, a smoother wealth transfer, and the ability to keep key assets like real estate or private shares in the family. And because your holdco is a separate legal entity, it may also help the following: avoid probate, protect wealth from public disclosure, simplify asset distribution across family members or charities. This makes the holding company a natural bridge between your business wealth and your personal legacy. So in summary, a holding company can help you with the following: receive business sale proceeds tax efficiently, freeze shares and shift growth to the next generation, retain control while gradually exiting the business, fund your estate through corporate-owned insurance, and distribute wealth cleanly and tax effectively after you're gone. It's one of the most versatile tools in Canadian wealth planning, but only if it's integrated with your personal, corporate, and estate goals. Now let's talk about when a holdco might not make sense. Here are a few cases where setting up a holdco might not be the right move, at least not yet. You're early in your business and need every dollar to reinvest in growth. You don't retain much profit and already draw most income personally. You plan to sell or wind down the business within a short time frame. You're not yet ready to invest retained earnings or use them strategically. The administrative cost outweighs the planning benefit. That's why the decision to set up a holding company or holdco should always start with your goals, not just the tax saving. It's about building the right structure at the right time for the right reasons. So those are the key advantages and the common missteps when it comes to holding companies. If you're building wealth inside your corporation and you want to protect it, grow it, or eventually pass it on, a holding company can be one of the most powerful tools at your disposal. But it only works when it's integrated into your bigger picture, because this isn't just about corporate structure. It's about aligning your business success with your personal goals, your retirement strategy, and your family's future. That's why I offer a free one-on-one consultation. What will we do? Well, we'll review your current business and ownership structure. We will identify whether a holding company fits into your tax, investment, or estate strategy, and we'll build a plan that connects your corporation to the life you're building outside of it. Click the link below to book your free consultation. Let's make sure it's tax efficient and working exactly the way that you intended. If you found this video helpful, please don't forget to like, subscribe, and leave a comment. I read every single one of them. Thanks for watching. I'll see you in the next video.